Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, good morning.
Morning.
Hi, good morning. There's so much to track geopolitically in terms of the developments on the Federal Reserve. And this comes on the back of a very painful week for our markets, where the Nifty was down 2.5%, the small cap index was down nearly 4%. So amidst all that noise and the earnings which are expected, how will we perform?
It's up to your IT boys,
Yeah.
IT boys and girls, Reema.
But I think they might just be overshadowed by what's happening globally, right?
Possible.
Possibly.
All right, let's get straight to the action then.
Absolutely. Let's just kick it up and take it from the top in terms of what you need to know as we begin a fresh new trading session. I think, the first news item, of course, is what did not happen. And this is, of course, the US Supreme Court, which was expected widely. And by the way, expectations rose as we went into the end of the week on Friday. I mean, started on Monday, Tuesday, Wednesday, and by Thursday it had reached a crescendo that, well, the Supreme Court is going to rule and they're going to strike down at least all of Trump's tariffs under the emergency IEEPA section, or is at least going to do it partly. Well, the Supreme Court did not publish its ruling, which is, by the way, also a possibility that we put out, that an opinion, but perhaps no ruling. Now, the court is likely to, but I just want to make it clear, not guaranteed to deliver a tariff decision this coming Wednesday. The point is, it's coming. So it didn't happen on Friday. Will it happen on Wednesday? Are the markets ready for it? Is it all in the price? I don't think so. Even though it's widely expected, I think if the court does decide to strike it down, and if we get a decision on Wednesday, I don't think it's in the price in that sense. Not in equities or in the rates market as well. The other bit of news flow on Friday was, of course, the US jobs report. And in a way, it had something for everyone, right? The actual absolute number was about 50,000 job additions. The estimate was about 70,000. But the one thing which markets focused on is the unemployment rate, which fell about 16 basis points to about 4.4%. And what that means is that the bar for Fed, as unemployment rate goes down, the bar for the Fed to cut rates perhaps goes higher. So it requires a lot more. By the way, there are 2 rate cuts priced in for this year. And I said it on Friday morning that it would take a lot for those expectations to change. I don't think this jobs data really changes that in any meaningful way. Now, on Friday, you've got the S&P 500, which ended about 0.65% higher. NASDAQ was up 0.8. Actually, 2026, it's been 10 days. It feels so much like 2025. US is right on top. It's doing exceptionally well. By the way, silver was up about 5.5% on Friday. Oil prices about 63, but they've been in a $3-4 range now, between 60 and 64. But it feels a lot similar, right? US equities, defense doing very well, precious metals doing very well, base metals at the margin, and of course, emerging markets like Korea, etc., which are also performing very well. Now, the Trump team is, and this is the other thread which I think we will see more and more of, the Trump team is pushing to address the affordability question ahead of the midterm elections. Remember, the midterms are only in November, but look at what is happening. President Trump proposed that interest rates on credit cards be capped at 10%. He said that large financial institutions should not buy single-unit family homes. He's essentially authorized MBS purchases by the government, some $200 billion worth, aimed at lowering interest rates on mortgages, that is, home loans. So, and I think there is perhaps that element of New York, what's happened in New York with Mamdani. Affordability is a buzzword in the Trump administration in a big, big way. And I think between now and November, we will see perhaps a lot more. All of this in any other period in time would have been negative for markets, right? This is government intervention into how markets work. But, well, so far markets are kind of ignoring it. At least, there's no durable impact in that sense. Well, the other bit of news flow here for us in India, and we discussed this on Friday as well, Sergio Gore, the US ambassador designate to India, and more importantly, he's very much a part of Trump's inner circle, is in India now. There was a flash visit. He met a lot of leaders, including Prime Minister Modi, but now he's in India, arrived this weekend and here to stay. And I think, people like, and I said this on Friday, Ashok Malik, etc., have said that this is an important piece of, the news flow which markets should not discount in terms of repairing relations between US and India. The other bit, of course, is all that is happening geopolitically. Venezuela, there is Greenland, and of course there is Iran as well. Protests continue in Iran. I mean, the level of international conflict that we have on our hands, perhaps unprecedented at any other point in time. Now, coming to markets here, severe pressure, absolutely severe pressure. The Nifty with 200-point sell-off on Friday has lost about 700 points from last Monday's high. Just looking bombed out. And it's actually even more visible in mid and small caps where there is tremendous pain. But remember, the small cap index, by the way, on Friday sold off almost 2%. I looked at the NSE 500 list of stocks. Only 40% of stocks in that basket, and that's the widest basket we have, are only 40% are even trading above the 200-day moving average. That is the Lakshman Rekha between being bullish and bearish, long-term average. But, it's an important indicator in that sense. So, mid and small caps, lots and lots of pain. With Friday's sell-off, the Nifty is now exactly at a very long-term moving average, which is the 20-weekly moving average. That number is 25,580. So that's the big support. The Nifty Bank has just broken the 20 days, a very short-term average. The Nifty Bank has just broken the 20-day on Friday, and that level is 59,412. So very tentative, very careful, and I think the only US-India will see whatever happens, and from the global side, I think it's all focused on earnings. If earnings growth picks up in the third quarter, I think, there will be bids and people would want to look at the market in a more constructive way, which has not happened for a while now. Nigel has walked across to the wall with the positioning and how is it all looking? Nigel, over to you.
Well, at the start of 2026, there were hopes that the FIs actually will lower their selling, or in fact will turn buyers. No signs of that, at least in the first couple of weeks that we've seen in 2026, because they sold close to 3,800 crores. Institutions, though, that's the DI and the FI put it together, they were net buyers. What's plaguing Indian markets? Well, one wonders, right? The FI selling is not abating. There's no breakthrough with regard to the US trade deal, and also geopolitical tensions all across the globe. And there is a bit of a skirmish on our borders as well. So maybe that's weighing on sentiment out here. But last week, we were rank underperformers, with the US markets actually doing quite well. What did the FIs do on index futures? Well, they went ahead and they added close to around 17.6 thousand short contracts in trade. And now the short positioning, if you just pull up a chart in the last week, it's up by close to around 50,000 contracts in the past week. You need to keep in mind that at the start of January, the F&O series, the Nifty lot size, well, that has been revised to around 65 from around 75 earlier. So effectively, we're at those peaks in terms of FI net short positions. And in percentage terms, we're at the highest we have seen all the way since October 2025. The FI's short positions at around 92.5%. Well, that's the highest we've seen all the way since the 14th of October 2025. But if you just see what history suggests, well, at that point of time as well, 10 sessions later, that's effectively between the 14th of October to the 29th of October, the Nifty actually bounced 3.6% on 906 points. The street will be hoping that with these FIs aggressively net short, what we saw recently in October can repeat itself in January 2026. That's the hope out there. And with the markets being so aggressively net short, the bulls will be really grabbing on to this data point. What happens from here on is going to be interesting, though, because the FIs, they're selling in cash market, they're adding shorts, and they're writing calls as well. They wrote close to around 3 calls for every one put position. And the strikes like the 25,800 call, 25,900 call, well, they were getting written very, very aggressively, with the premium coming down as well. So one data point is the FIs are net short. The other data point that the bulls will be looking at is the Nifty PCR. That's come down to around 0.62. History suggests from these levels normally we see a bit of a bounce. So that's the other data point that will be actually favoring the bulls to see some kind of a bounce from the lows of the day today itself. Well, the Nifty levels to track, we're trading below the 20-day MA, even below the 50-day MA. So now all eyes on this vicinity of around 25,500, 25,550. That's going to be important. Incidentally, that's where the 100-day MA comes in at as well. The problem in Friday's trading session was that the Nifty went ahead and broke the 20-day MA. But the good news is, at least Reliance Industries, in Friday's trading session, that managed to defend the 200 MA. And in fact, it outperformed in Friday's trading session. So I'll keep an eye out on that factor. Well, the stock that I'll be looking at post the SEBI chairman's weekend comments is BSE, because he commented on the derivatives volumes. He said that he doesn't think they need to disturb anything at this point of time. So I'll keep an eye out on BSE. He said this before as well, but maybe some kind of relief on this one. It's going to be an interesting trading session, but the PCR at the lower end and the FI net short positions at the up end, that's going to give some hope for an intraday bounce in today's trade.
Thank you very much for putting that in context. The FI sold 8,800 crore in the cash market, with the FI picking up significantly over the last two trading sessions. 8,800 crore in cash market selling in the last 5 trading sessions. Let's get to the equity calls then. It's Rajiv Batra from JP Morgan who says, despite the ongoing uncertainty around the trade deal, they expect earnings to grow further, underpinned by last year's low base, policy tailwinds and renewed economic momentum. He says their year-end bull, base and bear case target for the Nifty remains at 33,000, 30,000 and 24,000 respectively. They reiterate their preference for domestics over exporters. Meanwhile, Chetan Seth of Nomura says that the Asian stocks are off to a flying start, with the MSCI Asia ex-Japan index already gaining 3.5% in 2026 so far, driven by solid gains in the AI-themed market like Korea and Taiwan. While the AI have-nots like India and parts of ASEAN continue to underperform. They expect this positivity trend to continue, at least in the early part of 2026, and they expect the MSCI Asia ex-Japan index to hit 1,035 sometime in 2026, and that is an upside from the current spot levels.
Okay, well, that's some opinion, and we'll have some views coming in just a bit. But, well, this happened just, I think, an hour and a half out back, right? Wall Street futures have slipped after Fed Chair Powell essentially revealed, he posted a video message from the Federal Reserve handle on social media, essentially revealing that the Department of Justice in the US essentially has threatened criminal proceedings. This is in relation to his testimony before the Senate over renovation of the official Federal Reserve office buildings. He, of course, saying that, well, this is a political attack and this is basically directed at pressurizing the Fed to lower interest rates. Listen in.
On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned, in part, a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people.
And the Dow futures is opening under the shadow of this. What's also important to note is that while Powell's term as a chair ends in May of 2026, he has the legal right to stay on the board as a governor till January of 2028, which means that if he stays on the board as a governor, despite being ousted as a chair or not being the chairperson, he still gets a vote on interest rates. And the question is, will the criminal investigation maybe create a cause or a legal path to force him off the board entirely before 2028? But joining in now is Arvind Sangha, Managing Partner, Geosphere Capital Management, and David Chow, Global Market Strategist, Asia Pacific Invesco, joining in. Gentlemen, thank you very much for joining in. Wanted to get your thoughts in. You know, this standoff between the Fed, Trump has been building. We've been questioning whether the Fed will remain independent. But it's sort of hit a feverish pitch right now with this unprecedented video by, Mr. Powell, countering all the statements. How big a risk is this for the markets? Arvind, you want to go first?
Sure. I think the market has been extremely sanguine about everything that President Trump has been doing. But it's clear that, on the one hand, you have a government which, Bernie Sanders or Elizabeth Warren would be comfortable with in terms of threatening people like the defense industry last week. Now, over the weekend, going after the banks in terms of the interest rates that they charge on their credit card fees, and now going after the Federal Reserve. I think there's a risk here that, at some point it might be the straw that breaks the camel's back in terms of market sanguineness about whatever President Trump does having no consequences. And if Fed independence is at risk, that is clearly, market may celebrate lower interest rates on one side, but on the other side, I think it would give real concerns about, inflation and financial repression and other concerns which could cause economic uncertainty. So I think it's really negative, and I think it's very interesting that Jerome Powell, Chairman Powell, has taken a direct stance against President Trump. So it'll be interesting to watch what happens in the days ahead. But there's also stuff going on the political front in terms of Greenland, and then on the background, there's also stuff going on in Iran. So the world is looking a much more uncertain place, and yet the markets are behaving like everything is hunky-dory, which we are a little nervous about.
All-time high everywhere, right? 26 just like 25. Arvind, hi, morning. David, hi, morning. By the way, there is, as we speak to both of you, there is news coming in. This is Donald Trump. President Donald Trump has given an interview to NBC, and we'll try and get the sound bites out. He says that Iran called yesterday to negotiate, on nuclear. Essentially on, the attempts has been to prevent Iran, to ask Iran to abandon its nuclear program and nuclear uranium enrichment, etc. So I'm assuming this is the context. Iran called yesterday to negotiate. Meeting with Iran is being set up. This is according to President Trump. That's big. If it were to happen, this is, it's almost as though we were living in a real-time video game. It's like non-stop. Arvind, any thoughts?
Well, I'm not sure what to make of it, because Iran has denied that it has tried to make peace. But maybe Iran is concerned that this whole protests, which have become very, very serious, they want to cover their flank on the taking the pressure off from the U.S. front. But I'm not sure everything that President Trump says is completely factual. So we'll wait and watch what happens there.
He's you're right. But you remember, Arvind and David, last year there was all this talk of TACO and this thing. He's completely flipped that, right? I think he took it personally. He's basically doing everything he says he will do. Through and through, he's following through. David, your thoughts on the point that Arvind made earlier, which is that markets seem to be unbothered by everything which is happening. It's a highly news flow is also at an all-time high and very disruptive news flow, but markets have been unbothered so far. You think at some point this is going to take a bite out of the strength in markets, all of this?
I would maybe push back against what Arvind said. Are we whistling across the graveyard? Maybe a bit. Is the dollar likely to depreciate if this criminal probe goes through? Probably. Are U.S. assets going to look less attractive? Yes, probably. But in the near term, I think ultimately what matters is earnings. Are companies growing. And I think that that's going to continue to happen this year compared to last year. I mean, we have to think about in 2025, everyone worried so much about the tariffs, and it was supposed to be stagflationary, and they ended up not being so stagflationary. In fact, growth actually accelerated in the US better than expected. So ultimately, it's about fundamentals. And I think that if fundamentals are going to improve, not only in the US, but in other parts of the world. But I think that emerging markets are looking more and more attractive relative to US assets for a variety of reasons, including this subpoena that was just given to the Fed.
All right. Hi, David. And hi, Arvind. Good morning. Nigel on this side. Well, David, let me take you a little bit forward on that point then, since you're saying that the emerging markets are looking attractive. FIs, they appear to be on a prolonged break from the Indian markets. Is this temporary reallocation driven by global yields, geopolitical issues as well? Or is there a deeper shift in perception towards India? What's your take?
Well, I think that Indian markets massively underperformed last year. I think up around 3% compared to EM, which was up around 30%. And I think that it's just, India used to be the darling of emerging markets. It was the only index, the Nifty was the only index that outperformed the S&P over the past, 10 years from 2010 to 2020. But I think over the past few years, there have been a lot of other rising stars that have been coming up. For example, the AI trade, China over the past couple of years, Taiwan, Korea, a lot of these competing EM narratives that India previously didn't have to compete with are now out there. So I think that ultimately coming into 2026 and the year ahead, I think investors are looking to allocate, and I think that they will start to allocate more so to India because it's underperformed, but also because Indian earnings estimates are finally starting to improve. GDP growth in India is starting to hit more normalized levels. So I think that the India's story is going to improve over this year, and it should drive foreign flows back to India.
And you believe India will outperform in 2026?
I think that EM will outperform largely due to China. China has the biggest weight and EM, but I think that India is starting from a much lower base in terms of outperformance. I think that India could be one of the best performers for EM this coming year.
That's nice to hear after last year's underperformance. Arvind, getting back to your earlier point that how market sanguineness towards everything that's happening is making you nervous. Markets are shrugging off everything and hitting record highs day after day, at least on Wall Street. How would you position your portfolio? If you are nervous, are you positioning for risk off? What is your expectation, say, for the next 3 to 6 months?
Well, I wouldn't go as far as 6 months, but for the next 2 to 3 months, we are quite overweight anything that is to do with precious metals. We are long other metals names because we think the dollar weakness is one of the risks, and today's action against the Fed highlights that risk. So again, in a broader market sense, we are overweight, of course, some of the beneficiaries from a power infrastructure standpoint on the AI trade. This on a global basis, and I agree with David that emerging markets are likely to benefit because the U.S. market, could see flows out if dollar weakness because of expectations that Fed policy is going to be much more dovish than it makes non-dollar assets attractive. And I think the growth side of the story is looking attractive. And India, I think finally we're starting to see signs from a bottom-up standpoint, data like auto sales in December, electricity demand in December. There are other data points that we've been looking for signs that the domestic economy, and I think the GST moves and other things that the government is doing, are starting to show signs that 2026 could be a year where India stands not just on expectation that it should go up because everybody else is going up, but it should go up or it will go up because earnings are starting to reaccelerate. And I think that's going to be the key driver for India. But on a global basis, we're a little more bullish on India this year than we were last year.
What we're going to do is continue this conversation later on. Arvind and David, thank you very much, both of you, for joining us here on CNBC-TV18. And As I said, more later. We'll take a quick commercial break here. Let me just quickly run you through the interactions which are lined up on the program today. 8:40, we have IIFL Institutional Equities' Renu Baid to put the spotlight on the capital goods sector. That's coming up. 9 o'clock, we're joined by Avnish Roy of Nuvama Institutional Equities to discuss the Lemon Tree Hotel's restructuring plans. 9:20, Harish Krishnan of Aditya Birla Sun Life AMC is a market match of the day. 9:30, we bring you a special discussion on the textile sector as US Supreme Court holds of ruling on Trump's tariffs. Following that, we'll be chatting with Warburg Pincus on their 960-odd crore rupee investment in Lemon Tree's Fleo Hotels. Towards the end of the program, Latha in conversation on the state of India's private capex cycle with Mahesh Vyas of CMI and K. Ravichandran, Chief Ratings Officer at ICRA.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you today. We'll get to that in just a bit in our special Top 10 segment. I'll just highlight the few stocks: Lemon Tree Hotels, Avenue Supermarts, IRDA, Manappuram Finance, Tejas Networks, Phoenix Mills, Vedanta, UPL, and Rallis India. They'll all be reacting to positive news flow, while we have Dr. Reddy's laboratory that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. Asia is tracking the gains and the record close across Wall Street on Friday. The Japanese markets are shut today on account of coming-of-age holiday. But you've got a 1% plus rally on Kospi, Taiwan, almost up nearly 1%. Hang Seng China have opened up mildly in the green. The GIFT Nifty will also come up for you on your screen. But the Powell probe hangover is still hurting Dow futures, which is down close to more than 200 points. But let's get to the stocks then. Our entire research team is standing by with the CNBC-TV18 list of top stocks for the day. Good morning, everyone. Full house. Mangalam, you start first. Some restructuring at Lemon Tree Hotels.
Yep, it's an interesting deal that is announced. We had an inkling of that as Yash spoke to us and, broke that story last week. But importantly, it's the restructuring, value unlocking and fundraising. Essentially, all these three are announced together. What they want to do is create two separate entities. One is Lemon Tree Hotels, which will be a pure play asset-light hotel management platform, which will basically have high ROCs, high margins. They'll collect management fees. And then there'll be Fleur Hotels, which will have an ownership platform with development capability. So all the hotels will sit under Fleur. Warburg Pincus will acquire 41% stake, which is currently held by APG in Fleur, and they will further invest 960 crores in Fleur Hotels in tranches whenever required. What the scheme is that Lemon Tree will merge two of its wholly owned subsidiaries with itself first. 4 of Lemon Tree's hotels will merge with Fleur against issue of Fleur shares to Lemon Tree, and finally Lemon Tree will also transfer 12 hotels and the ones under development to Fleur for issue of shares directly to Lemon Tree shareholders, for which Lemon Tree shareholders will get 20 shares of Fleur for every 311 shares that they hold in Lemon Tree. As a result of which, we will have two companies. Fleur Hotels will be a listed entity within 12 to 15 months. Lemon Tree will be a high growth, high ROC, zero debt company. And post this scheme, Lemon Tree will define a dividend distribution policy to reward shareholders annually as well. So all three things done together, the street likes it. Brokerages have not changed their target prices yet, but they will await further clarity from the management on the structure, the growth patterns and the balance sheets of both these businesses going forward. But the fact that it's announced, going with green on that.
Okay, all right. Mangalam, thanks a lot for that. That's on Lemon Tree. But what about Avenue Supermarts? The quarterly update wasn't great, but the margins were a pleasant surprise. Tell us more.
That's correct. So when the quarterly update was lower than expected, the inkling one got was that it's because of GST rate cuts, there are lower realizations. And that exactly is what, the margin surprise and the management commentary confirmed. So the street was expecting about 8 to 10% EBITDA growth. The company went ahead and reported 20% EBITDA growth. So the consolidated EBITDA margins were at 8.1% versus 7.5%. The street here too was expecting a compression, but the company's gone ahead and shown margin expansion. And a large part of that is on account of gross margins, which improved by about 60 basis points. Here too, the sense that I get is that there is a slightly higher share of revenue coming in from the company's own private label brands, and which is why it is more gross margin accretive. Management has said revenue growth, which was 13%, was partially impacted due to deflation in staples. So all in all, 13.5% revenue growth on a consolidated basis. Gross margins expanded, EBITDA up 20%, 18% PAT, and like-for-like growth, while it's 5.6%, it's on account of lower realizations. So because the stock has already seen a mild correction post its quarterly update, and the store expansion is also positive, going with green on T-Mart.
Thank you. Got that. Green for Avenue Supermart. Some margin expansion. Ekta is now joining in on Dr. Reddy's.
Well, yes, Dr. Reddy's is in focus because they've received a letter which is basically a post-application action letter from the US FDA for an inspection which took place at their Bachupalli facility, which took place in September. Now, this particular letter is a response submitted by the company following an inspection. Now, what this basically is basically for a biologic that they had applied for in terms of approval. The US FDA has more questions, and hence they've issued this letter to Dr. Reddy's, and Dr. Reddy's is going to respond to it. In my understanding and speaking to analysts, it is different from a complete response letter, which has a tinge of US FDA issues attached to it. It's more about asking for additional information. Maybe we could see a little bit of a mild red on Dr. Reddy's because there could be a delay in their biologics application process. But overall, it's different in terms of a complete response letter because it's asking for more additional information as compared to bringing up an issue with the application.
Okay, all right, Ekta, thank you very much for that. IREDA and Manappuram Finance are in focus. Sud is here with details. Sud, morning.
Morning, Prashant. So, IREDA last week had released Q3 updates, and disbursements in Q3 was slightly weak if you compare against H1 of FY26, but results are looking good. Profit has increased by 37%. Even there is a healthy improvement in net interest income. There improved by 35%. Improvement in the asset quality as well. Gross NPA has come down to 3.75% from 3.97%, and net NPA has come down to 1.68% versus 1.97%. So here also almost 30 basis points improvement. Second one is Manappuram. If you remember, Friday afternoon, there was a Reuters report that RBI has raised concerns related to Bain Capital deal. Now, Manappuram has issued the clarification post-market on Friday, and it has denied the report. It's saying that it's factually incorrect and speculative in nature. Now, it has given the detailed timeline. First, it had got the approval from RBI for the deal, and after that, RBI had asked certain clarification to which Manappuram had clarified. Also, now it's waiting for the final approval from RBI. But as far as the Reuters report is concerned, Manappuram has comfortably denied. And today also, gold and silver, both prices are at the record high.
Okay, all right. Thanks for that, Sir. So Manappuram will be a stock in focus. Got slammed in the final 90 minutes of trade on Friday. A clarification coming about, so let's see how the street reads that. But let's hop across to Upasana. She's here to tell us some stocks in the news. Hey, Upasana, morning.
Good morning, Nigel. First up, let me start with Tejas Networks. The company has reported a sequential uptick in terms of its revenue, with an uptick of 17% on quarter-on-quarter basis, but there's a 88% Y-on-Y decline in terms of its revenue. Now, the weak sales was mainly impacted by the company's delayed in major BSNL orders, and this delay continues to persist is what company is indicated. Now, in terms of losses, the company has reported losses for the fourth consecutive quarter, with Q3 losses at 196 crore versus a loss of 307 crore sequentially. Next up is Phoenix Mills on the back of its Q3 business update. The retail consumption has seen an uptick of 20% on a one-year basis. And if you look at the 9-month figure, there is an uptick in consumption of 15% on a one-year basis. Now, company says that the consumption growth continued to remain strong. Select assets continue to undergo planned revamp and premiumization initiatives to strengthen the company's portfolio going forward. And lastly, coming to Vedanta, the company has received NCLT nod for demerger scheme with Talwandi Sabo Power Private Limited. So all in all, we'll be tracking all these stocks today.
Thank you very much for that. And now it's over to Ria on UPL and Rallis India.
Well, yes, good morning. Some reports have suggested that China has cancelled the export tax rebate for pesticides, including glufosinate, starting from the 1st of April of 2026. Now, as a result of this, the FOB price of these products will immediately rise by 9%, and it is anticipated that by the 1st of April, some overseas customers will also place advance orders in order to stock up for these products. Now, as a result of this, players like Rallis and UPL, for UPL, remember, glufosinate is one of the key herbicides in their portfolio. Both of these companies may see some short to medium term benefits, both in terms of volume and margin uplift.
Thank you very much. For that, let's do a quick recap then of the top stocks you should have on your radar. Stocks with positive news flow are Lemon Tree, Avenue Supermart, Ireda, Manappuram Finance, Tejas Networks, Phoenix Mills, Vedanta, UPL, Rallis. Well, Dr. Reddy's could be the only stock on our radar that could open in the red, but that's on the back of news. But now it's over to Manisha, because gold, silver continue to hit record highs. It's a big pop-up, opening gap up, and crude too has spiked, Manisha.
Oh, absolutely. Almost everything in commodities seems to be doing quite well. So that tells you the pure economics fact that when you are there, you are looking at uncertainty. It is the tangible commodities that continue to do well. And we also are looking at geopolitical concerns. So gold prices have hit a record high of $4,600 an ounce. 5,000 is a level that most banks and brokerages believe you will see in the first half of 2026 itself. Silver as well is trading 4% higher, $84 an ounce onto this one as well done. We are looking at a decline in dollar index. The news coming in from the U.S. Federal Reserve and the fact that you have seen weak U.S. payrolls data have been supportive factors here. Strength has continued for the copper prices also. We saw all-time highs in the previous week, and that's exactly where copper is trading right now. The major gains clearly have come in for the crude oil prices. We started this year with almost $59 or $60 a barrel. We are trading at $64 right now. This is due to escalating protests in Iran, uncertainty over Venezuela, and of course, U.S. President saying that financial support and Venezuelan oil to Cuba could be cut off. So various statements and the impact on ground clearly can be seen in sense of bullish prices.
Okay, all right. Thanks a lot for that, Manisha. For the time being, though, I think we'll slip into a short break. Come back, we'll connect with Dharmesh Kant, Head of Research at Chola Securities, for some fundamental stock talk. Stay tuned. Welcome back. Hope you're having a good morning. Well, as promised, we're going to get some fundamental analysis going. Dharmesh Kant, Head of Research at Chola Security, joins us on the show. Hi, Dharmesh. Good morning. Good to see you in. The tech results start rolling in today, but over the weekend, we got a result coming in from DMart, Avenue Supermarts. And actually, the update that they put out was a little bit weak. But the results are not too bad. And I'm just going through Jeffrey's note. They say that the EBITDA margins have come in at the highest they've seen in the last 6 quarters. Some kind of relief, at least on that front. What's your view on the stock from here on? It's corrected substantially from the top. It's been under big pressure. But now it appears, at least in the profitability aspect, there's a bit of a beat.
Yeah, good morning, Nigel. Thanks for having me for the show. Definitely, results were a bit better than what the expectation was going by the updates on the revenue which they have given. And they have also added 10 new stores, so that also, will suit well with the trading community. But to my mind, still, the Avenue Supermarts is not a structural wealth creation kind of a buying value. You can get a trading gains if somebody is buying here, 10-15% kind of a pop-up may still happen over a few months. But what I think is this is the best they can do going forward. So 24-25% kind of a PAT growth, 8.5% kind of an operating margin is the best in light of the competition which has been hitting up. And stock is still valued at around 75 to 80 times PE multiple basis even 1 year forward. So such kind of a valuation multiples with 20 to 25% kind of a shaky growth is hard to sustain going forward. So trading play is on, but if somebody is looking for a fresh entry for a wealth creation kind of a concept for 2 or 3 years holding, to that the answer is avoid.
Point taken. Dharmesh, hi, morning. This Lemon Tree news, the information coming through, and by the way, we had reported on this just 3 days back. So in that sense, it's a confirmation of our story. But what did you make of it? Any thoughts?
Yeah, good morning, Prashant. I mean, we haven't figured out the valuation part as far as that is concerned. I mean, more details are awaited, and there we will work on the numbers as to how it goes through. But structurally, entire travel and tourism industry is on an upswing, and we have seen the discretionary spends are getting invested there. And they, if you are buying a lemon tree hotel as of now, so investors have a choice of retaining either of the two businesses. One is the asset-light model on the servicing part, and the second one is the Fleur is a pure play on the asset ownership. So, I mean, it will make sense if somebody gets into for trading play for some time, and thereafter, when the further details emerges and the valuation can be ascertained, one can hold whichever one likes. Structurally, for next 3 to 5 years, this entire space is looking very good, and Indian hotels we have been recommending for quite some time to be added into the portfolios.
Value unlocking for Lemon Tree with this restructuring in a way. We'll wait by to see how the stock reacts. Dharmesh, any commodity plays that you're recommending at this juncture? Because across the board, stocks have run up. So from here on, any stock where the risk reward still looks attractive?
Yeah, good morning. Definitely, yes. I mean, commodity is a structural theme in the making, and I think this year again, 2026 would be good for all the commodity players who are the producers of them. And dollar index is also helping them. It is not much is happening out there. It's benign. At the same time, interest rates cuts are expected from across the board. So recent development in the US may even speed up the interest rate cut. So there we have been liking Hindalco for quite some time. Though valuations are now reeling the +1 standard deviation kind of a zone, but still I think a lot of juice out there. And Vedanta is the second one in play. Both benefits from aluminum, copper, price upswing which is happening in the international market. At the same time, Vedanta also have a similar pace. They have not mined yet to that extent from the Hindustan Zinc for 2 quarters, but maybe going into the fourth and subsequent quarters, this output increases, so that will be a value accretive. And for the ferrous play, JSW Steel is one which we have been liking for quite some time. And also in light of safeguard duty, which has been levied, again, an elbow room has been created for them to speed up. So though higher, volatility will be there, but structurally, if you're buying it for a 1 year perspective, I think plenty of upside is still left.
Dharmesh, stay with us. You may want to listen to the next conversation. We'll ask you as well, right? Capital goods stocks and power especially all sold off aggressively over the last 1 week or so. There was that story, of course, which talked about, Chinese companies being allowed to bid for government contracts in India. And, this is, of course, after they were disallowed to do so after the Galwan clashes in 2020. It's all been source-based reporting from various media outlets. But, of course, I mean, the damage showed up in stock prices. Names like Hitachi, BHEL, so many CG Power, fair bit of damage occurred after these stories. Renu Baid is with us, Senior Vice President, Research at IIFL Institutional Equities. Renu, good morning. Good to have you with us here. As I said, this has all been source-based reporting. I don't know if you've been able to get some clarity on this first up. We've been trying to talk to companies individually, and some companies have told us that, especially in power transmission, etc., this is true. I mean, it's not without nothing. So just wanted to start there, Renu.
Yeah. Hi, morning. So clearly there has been no government notification of lifting the restrictions. Doesn't seem to be the intention so. But even our interaction with industry experts suggests that in the transmission space, power transmission, high voltage, apparently for reactor category, one of the Chinese manufacturers who are based out of India for over a decade, TBEA, they have been approved for reactors, that too for next financial year. So there have been approval for them. It's not that the restrictions are lifted. So there is no risk of imports here at the moment. But yes, in the transmission space, where players were constrained on capacities and the average pricing in the market had shot very sharply, there we are hearing Chinese players or their factories which are based out in India are now being allowed to participate in future bids.
Any other companies?
Sorry, just one thing, Renu. Just one. You're saying that in high voltage reactors, in transmission.
This is the extra high voltage, 400 and 765 kV.
So this is transformers, just to get it.
These are reactors. The capacity which is used for transformers is also used to make reactors.
I see. Because I saw this reactor bit on social, etc. And well, people were asking whether this is, when you say reactors, you automatically start to put nuclear in front of it.
No.
Yeah. So this is in high voltage transmission. So just to give us a put a name to it. This is the kind that Hitachi, etc. are involved in.
Yeah, in this space, we have Hitachi Energy, GV Vernova T&D. There is CG Power, transformer rectifiers, who are pretty active in this high voltage, extra high voltage space.
And they've been, so this is Chinese companies with facilities in India, manufacturing facilities in India.
So this company called TBEA Energy, they were, as the factories were established in India way back in 2014. And they were very active. They were, in fact, they used to have the market leadership in volume terms with Power Grid then. But after the Galwan clash, Chinese entities were not allowed to participate in India, irrespective of whether they being a local manufacturing entity or not. So this company is very well a domestic company from a local manufacturing footprint perspective. And they have been operating in India since then. They have been exporting, and last few years, they've been supplying to private transmission utilities and exports, though they have not been dealing with directly Power Grid or the state utilities or government contracts, basis the restrictions which were there.
Renu, so now, particularly in this segment where TBEA seems to have been approved for a particular project for the next fiscal year, and that is negative for companies like Hitachi, GE, Vernova, T&D. Now with, say, case by case, in the case of, say, TBEA, what would be the market competition now? How would the competitiveness change? Because typically what we hear is that Chinese bids are lower, 10%, 20%, 30%. And plus there is increased competition. So what happens to these companies? And is there any other example where a Chinese company has been appointed for a order?
Well, we still need to see the details. Typically, Chinese players don't have a great track record when it comes to maintaining price discipline. But that was the case during last cycle when demand was extremely weak and there was excess supply in the market. In today's environment, if we count TVS capacity, which is almost close to 50,000 MVA, the capacity has been very much active in the market. So as a market as a whole, which comprises of public, private and exports, the capacities were already there. So there may not be a nosedive impact on pricing because they are also very well occupied. The factories are full for them. It's just that they'll be now re-entering the government space, that too for reactor as a category to start with. And for a segment, if a private utility was using the capacity earlier, which now will partially be used for the Power Grid orders, the private utilities which was dependent on or using PBS capacity will now look for other vendors as well. So for a market as a whole, it will take time for prices to moderate. Nonetheless, I would want to highlight that over the last 2 years, most of the capacity expansion which was announced by companies in the space, most of those capacities are coming up for commissioning in the current calendar year. So anyway, the transformer industry supply or manufacturing capacity of transformers is expected to near double in the next 12-15 months. So whether TBA was allowed or not, market prices were expected to correct. It's just that the entry or the announcement of Chinese-owned manufacturers being re-allowed in the market will have a sentiment overhang on the companies. We don't perceive or foresee any material impact on earnings or sudden crackdown on the market pricing because capacities are constrained.
Okay. So stock prices, the names that you mentioned, they're adequately factoring all this, Renu?
We think, they are now consolidating and valuations ought to correct for increased competition and the risk which market is discounting.
And you don't think that in other areas this is going to happen, in EMS and things like that?
No, this restriction was placed way back in 22 on power and infra segment. So power generation and T&D generation, unlikely that NTPC, which is a central government utility or SEBs may directly use Chinese equipment. Anyway, on the BTG side, there are no domestic Chinese manufacturing facilities. If at all, they'll have to import. But private sector usually is more comfortable with Chinese vendors than state utilities like NTPC, central and state utilities. In other
Renu, back in the day, BHEL and all used to, there used to be a lot of boilers and all used to come, right, from China?
Back in the days when BHEL was the only manufacturer, Chinese used to have almost nearly 35% market share, but largely concentrated in the private sector hands. So private utilities or IPP players were the customers who were very keen to use Chinese vendors, both for cost and delivery timelines. In today's environment, BHL, L&T both are full on their factories. We have seen JSW acquiring GE Power boiler facilities. So probably in the next 12-15 months, JSW should start participating, both using the boiler and the turbines which they have through Toshiba. But on the government sector contracts, we don't think, at least our perception is NTPC as a customer has never been comfortable with Chinese vendors. And I don't think so they would reopen the door. And if at all, there is a minimum localization requirement which none of the Chinese manufacturers have in India. So on the generation side, it could be imports, but that too on the private sector, nothing on the government utilities or customers front.
You know, I just want to talk about other issues with the EMS, right? I mean, memory prices surging. What does it do to companies like Dixon and others, etc.? But I'm out of time. We're running into market pre-open. Renu, thank you very much, and we'll invite you back on the program. Thanks very much for joining us here. We'll take a quick commercial break here. We're going to come back in just a bit. Some volume buzzers from Friday's session, some price action that we're going to focus on. Sudarshan Sukhani and Mitesh Thakkar also with us with some technical trading ideas. Stay tuned. Coming up. Okay, welcome back. 5 minutes to go for the pre-open session. Hormuz is here with the big movers on Friday with heavy volumes. Hormuz, morning.
Morning, Prashant. And IEX cannot talk about it. The price action that you saw on Friday's trading session, almost 8% lower, had tumbled back towards its 52-week low levels as well on Friday. And of course, the volumes on that day were the highest since July of last year. On that day, when the stock fell 30% in a single session, almost 22 crore shares were traded on IEX on Friday. The 20-day average is just around 1.5 crore. And out of those 22 crore shares, 2.5 crore shares were marked for delivery. Year two, the 20-day average is around 40 lakh shares, so 5x in comparison to the 20-day average in terms of delivery volumes. And Friday's turnover as well, close to 3,300 crore, almost 30% of its free float market cap. Now, HDFC Bank is another name, and it wasn't a big price mover, but it has been the one big factor as to why the Nifty did what it did last week. Declined on all 5 trading days. The worst week that the stock had since January of 2024, down almost 6.5% last week, and delivery selling worth almost 13,000 crore took place last week on HDFC Bank. Friday's volumes were the second highest in the week gone by, and almost 4 crore shares were traded on Friday, 20-day average of 2 crore shares. And out of those 4 crore shares, 3 crore shares were marked for delivery, and the 20-day average here was just around 1 crore. And the stock from its 52-week high, which it very recently hit of 1,020, is already down 8% from those levels. And lastly, MTAR Tech defense names are moving higher in the recent times. The biggest single day gain in the last 3 months was up 14% last week. It was the best week that the stock had in 3 months. The volumes on Friday were the highest since September of 23. So the stock moved on very significant volumes as well. Close to 50 lakh shares were traded. The 20-day average is just 2.5 lakh shares. But out of those 50 lakh shares, though, only 5 lakh shares were marked for delivery. Here, the 20-day average is less than 70,000 shares. And in that 6% move that the stock had on Friday, the stock hit a 52-week high on an intraday basis.
Thank you very much for that. And with the FI selling intensifying last week towards the end, a lot of these FI stocks where there is a lot of FI ownership, like HDFC Bank, Reliance Industries, also took a bit of a knock. And that's one of the stocks Hormuz identified. We will slip into a break. We'll come back with the pre-opening rates. We'll also be joined by Abneesh Roy of Nuvama Institutional Equities to talk about the Lemon Tree Hotels restructuring plan. Stay tuned.
Welcome back. Well, we're going to be getting our pre-open rates that have gradually started trickling in, but a good time to get in our technical experts. We have Sudarshan Sukhani, proprietor technical trends, as well as we have Mitesh Thakkar, president retail research at Bonanza Portfolio, who joins us on the show. Good morning, gentlemen, and good to see you all in. Well, Mitesh, you go first. The structure clearly has been weak over the last few days. We're making lower lows and lower highs as well. And there's been a one-way slide, 600 to 700 points or thereabouts. What the bulls will be hugging onto is the PCR has come to the lower end of the range, and the short positioning is at around 1.9 lakh contracts. What's your view? If we see some kind of weakness today, would you look to buy, or do you think this market is actually breaking down?
Morning, Nigel. So I think, a couple of things. One, Nifty has broken some averages on daily charts, it's broken a rising channel, which was around 25,950, 26,000. And with that, I think, there's a good possibility that the near-term structure is weak, and we could possibly, head towards levels of 25, 350, 400, which is where we had a intraday low on the 7th of November. So that's the support pivot. And that's an area where also a couple of weekly averages coming. So to my sense, I think, there could be some volatility. There could be a day of short covering when a pullback could happen. But broadly, I think stronger bottom could be made around 25,400. So one, I would want to go long only if we get closer to those levels of 25,400, 350. And on the upside, I think this weak structure will persist till we get past 25,950, 26,000. So that's my range on the upside. The structural bias in the short term is negative, so I would believe that there's a good chance of testing 25,400, 350 before giving an upside risk.
Got it. All right. So you'll be a buyer only at around 25,400 or thereabouts. Sudarshan, what about you? How are you feeling about the markets?
Good morning. It's almost the same view that Mitesh was talking about. See, two things have happened. First, a very significant support level of 25,700 was breached decisively when the Nifty closed below it on Friday. Second, that closing also at least gives a sense that a double top is getting confirmed. Now, the confirmation comes later when the market keeps on sliding, but the pattern is now clear and visible. So that's not good news. So all said and done, this market's first support level is 25,400. The chances are that given the current technical picture, we will slowly slide towards that support level. News can change it in a minute. That's a different matter. But I would expect the markets to keep sliding down with small rallies in between.
By the way, some update coming through on Kotak Mahindra Bank. Kotak Mahindra Bank has appointed Anup Kumar Saha as the whole-time director of the bank. He will look at the consumer banking and the digital business of Kotak. Remember, he is the ex-CEO MD of Bajaj Finance. He was one of the contenders for the top position at IndusInd Bank. That didn't happen. And now he's been appointed by Kotak Mahindra Bank. And the question is, will he bring that growth mindset, that aggressive growth mindset that helped Bajaj Finance become a titan in its industry and help Kotak Mahindra Bank build its consumer and digital portfolio? So important update coming through on Kotak Mahindra Bank. Gentlemen, morning, and thanks for joining us this Monday morning. What about stocks, Mitesh?
Yeah, good morning. I have actually a mix of buys and sells, two buys and two sells. On the buying side is Dabur. When this entire decline, Dabur has been sideways, the overall structure is positive. So keep a stop at 519 and buy it once it breaks above this recent consolidation range of 525, 526. Keep a stop at 519. Look for targets of 540. Bosch is a positive chart which is given a pullback to its 10-day average. So buy here with a stop at 37,600 for targets of 38,700. And on the selling side is L&T. Sell on a mild pullback, let's say around 40.40. Keep a stop at 40.90. Look for targets of 39.50. And Geo Finance is a sell as well. In the short term, it could decline to about levels of 275 and keep a stop at 292.
Got it. All right. And Sudarshan, what about you?
It's also a mix. HCL Tech is a buy because IT has been a little better. Buy with a stop under 1630. Asian Paints is another buying opportunity with a stop under 2790. DLF is an intraday short with a stop above 685. And Adani Enterprises is another short with a stop above 2200. Take the long positions only if you find some stability, not otherwise.
All right, gentlemen, we'll come back to you for 9-10 calls. For now, let's address Avenue Supermarts and the margin surprise. Abneesh Roy, Executive Director, Nuvama Institutional Equities, is now joining in. Abneesh, your first read of Avenue Supermarts. And is there enough in the performance for you to go ahead and buy the stock today?
Hi, good morning. Yes, it's a good number. I think this stock is in the oversold zone. Of course, FI is selling, we need to see. But I think a few key positives in the results. So clearly, around 50 bips improvement in gross and EBITDA margins. Even in terms of DMart ready, our calculation suggests around 20% kind of a growth, which is a reasonable number. Third, of course, is in terms of store addition, around 28 stores in the 9 months they have done. And generally in Q4, the quantum of stores really addition improves. So we see that around 60 stores addition can happen. It is not a cheap stock, but I think it's an oversold stock. So I think near term it should do well. Here we need clarification on whether the gross and EBITDA margin sustainability is there or not, because it has corrected a lot in the past few years. So it could be bottoming out. Last 2 quarters also, there was a small dip. This quarter, there's a small improvement. So sustainability is important, but yeah, near term, the stock could react a mild positive because of this number.
All right. Hi, Abneesh. Thanks a lot for joining in. So maybe some kind of relief is what we could see, since the quarterly update wasn't too great, but the margin surprise is encouraging and the stock has fallen considerably. What about Reliance Retail? Any read-through? I recall when these numbers came out, Reliance as well was under pressure. There was some fears that Reliance Retail as well will see some pressure. What are your expectations? Those numbers come out later this week.
I think difficult to take away from one result to another, because retail, as you know, is fairly competitive and every company will have its nuance, and the business models are different. Demand is much bigger and all those. But yes, we do see that in this quarter, the GST transition happened. So is there any interplay between the reduced discounting and GST rate cuts? We need to see that. Second, of course, for DMart, one more thing which is positive in terms of lease, because generally DMart likes to own the stores, which limits the expansion. What we are picking up clearly, lease liabilities versus assets, we see a movement there. So that could mean that in the new market of UP and some of the other market, companies a bit more open on the lease rather than ownership. So I will say that yes, we need more clarity here, but I think every retail company will have to take on its own rather than extrapolate.
What's the fair valuation multiple for a company like Avenue Supermarts, which is facing increasing competition from quick commerce, and it's showing up in the numbers? Revenue, same-store sales growth is slowing down. Not talking about this quarter where there could be an impact because of GST rationalization, but as a broader trend, what is the valuation multiple that you think is appropriate for this company?
So yes, you're absolutely right. Currently, if I see the stock trades at 90 and 75 times FY26 and 27 P multiple, we have a target price of 4351. So we see small upside here. You are absolutely right. E-commerce, quick commerce, new players are also coming. Amazon now has become extremely aggressive, which may bode well for the FMCG companies, especially food companies. But that also means that Avenue Supermart and some of the other players in quick commerce and generally retail, they will see that competition. So that continues to remain. I think for the significant re-rating for Avenue Supermart, around 17-18% sales growth and slight margin recovery, I think that will be needed. So we'll say that currently 4351 seems to be the reasonable target price at this juncture.
All right, Abneesh, very quickly, there are two stocks that have got hit very hard in the last few trading sessions. One is ITC, post that tweaking in the duties. The stock is down 16%, I think, in this year itself, and we're only getting started. And the other one is Trent. That as well is down close on 7% post their quarterly update. Any view on both these two names? Would you look to buy either of these two?
Sure. Firstly, I'll take on the retail trend. Our topics currently will be Titan and Jubilant Foods. Avenue Supermart's near term could do well because of the margin surprise. So trend as of now, we continue to wait for improvement in terms of growth numbers, margins, etc. Coming to definitely ITC here, I think FI selling continues to remain a overhang, but in terms of pure valuation, dividend yield around of 5%, improvement in FMCG, agri, paper, etc. Those are positive. I think the stock further downside seems limited. Only FI selling continues to be a unknown development, because we are seeing that across the board that selling is happening. One more important thing is, I think in February and June, we expect 2 rounds of price hikes by ITC to pass on that. So, and next year, the chance of a tax hike remains very, very low given the quantum. I think from a 2-year perspective, ITC makes sense. Near term, definitely overhang is there, but I don't think the correction too much I expect on ITC from here on, except the FI selling, which is very difficult to predict.
Okay, and there are price hikes on the anvil in June for ITC, as you expect. Thank you very much, Abneesh, for joining in. Back to Sudarshan for his 9:10 call.
Well, DLF is an intraday short with a stop above 685.
Mitesh?
I will go with the sell call on Geo Finance. Keep a stop at 292 for targets of around 275.
Okay, now let's get to the brokerage call of the day. It's Macquarie on financial. Sudarshan joins in to tell us why he's picked this.
Expecting more than 15% earnings growth for banks in FY27, and some of the key factors that it has mentioned. First one is improving margins, second falling OPEX, third is credit cost, and even the valuations Macquarie is finding very reasonable. And it's positive on PSU banks and life insurance sector, and it believes that large PSU banks will deliver sustainable 13 to 14% ROE, and for life insurance there should be improvement in VNB margin as well as growth. So it has upgraded SBI to outperform from underperform. Target is increased to 1150. Upgrade Paytm to neutral from underperform, and target is increased to 1265. Upgrade HDFC Life to outperform from underperform. Target is increased to 900. Upgrade SBI Life to outperform from neutral, and target is increased to 2360. And downgrade Bandhan Bank and SBI Card to underperform from outperform and neutral.
Okay, all right. Thanks a lot. Thanks a lot for that, Sudarshan. Well, I think we can hop across to Mitesh. Mitesh, for his 910.
We did that. He's got a sell call on Geo Finance.
Right.
So that's the 910 call. Mitesh, anything on the... All right, we've lost it. But you should also keep your eye on tech names, because both TCS and HCL Tech will be reporting their Q3 numbers post-market hours. For TCS, expect a fairly lackluster quarter on account of seasonality, etc. So I think the constant currency revenue growth expectation is just about 0.3, 0.5%. But the company is turning aggressive. So the street will want to know more about, they've made an acquisition, they've made investments in data centers. So more on that. And the other one is HCL Tech, which will have a very strong quarter, nearly at 2.5%, 3% top line growth on the back of seasonality in their products business. But it's over to Mangalam now. He's joining in for more on Lemon Tree Hotels and the restructuring.
Well, that's right. So the company announced a strategic business decision along with value unlocking and restructuring of the company with fundraising as well. So let's just put this into perspective. Lemon Tree currently has about 58% stake in Fleur Hotels, 41% is at AVG. Warburg Pincus will go ahead and buy that 41% stake from them. And at the same time, what the company will do is Lemon Tree will take 2 of its wholly owned subsidiaries, merge it within itself, and at the same time have 4 of its subsidiaries which will go along with Fleur Hotels. For those 4 subsidiaries, Lemon Tree will get shares of Fleur, and at the same time they have about 12 hotels which they will then give to Fleur Hotels, for which the Lemon Tree shareholders will get Fleur Hotel shares. So eventually the resultant structure will be 2 companies. One will be Lemon Tree Hotels, which will be the company that manages hotels, and along with that we'll have Fleur Hotels, which will be the company which has a platform of all these hotels which will then be developed as well in terms of assets. So together, Warburg Pincus in Fleur will go ahead and also have the right to go ahead and invest about 960 crores of equity as and when called for in tranches. What the street really wants to understand from here on is how the growth rates of each of these companies will be. As of now, Lemon Tree will have, the hotels company, which will have about 70% EBITDA margins in as a branded business, as a managed business, and Fleur will have about 42% margins. So all these factors, we will await more clarity on this day.
All right, I think just market opening, it's been a terrible, terrible last 1 week. 16 points lower, absolutely flat now on the Nifty. The Nifty Bank is also slightly in the green, but not very much beyond that. The small cap index is flat. The mid cap index will come up on your screen. And I think there as well, there isn't very much at all, which is kind of discernible in any meaningful way. So it's flattish, I guess, this morning. I think the Nifty 50 heat map will give you a quick sense of how we're starting, and then we look at individual names with regards to moves. HDFC Life, SBI Life. I mean, so the life insurance data, came through. And I think the reaction is on account of that. On the other end, you've got Max Health, BEL and Indigo, which are coming up under pressure at this point. 20 points lower on the Nifty is what you have. It's absolutely flat. Rima.
Well, Avenue Supermarts is a standout performer, 2.5% up. We knew the revenue growth numbers at 13.5%, but the street likes the improvement in margins. Avenue Supermarts has opened up strong. Then you've got HDFC Life, SBI Life, both of them gaining nearly 1%. Hindalco continues with its up move, so that surged over 1% in early trade. Some of these stocks, on which are dependent on crude prices, are moving in different directions. So Brent crude price surged on the back of rising risk in Iran. Brent is at $63.50 per barrel, almost hit 64. Asian Paints is up 0.5%, but on the flip side, you've got Interglobe Aviation, which is down nearly 1%. And some of these oil marketing companies should also come up for you on your screen. IOC has a downtick to begin trade with. One of the stocks which is in news today is Lemon Tree Hotels, where there is monetization, restructuring, value unlocking. Lemon Tree Hotels has opened up with strength. BEL is seeing some profit booking after last week's run. Defense rearmament is emerging as a big theme globally, and even stocks in India had a good run. BEL from the start of January is up nearly 3.5%, but seeing some profit booking. Eternal opening up in the red. Apollo Hospitals, ICICI Bank. In fact, HDFC Bank and Reliance Industries should also come up for you on your screen since they were the big drags last week. HDFC Bank down 0.25% and Reliance Industries down nearly half.
Well, a few stocks that are actually outperforming today. IRDA, well, that stock is up and about in today's trading session. Good move is what we're seeing, up closer around 4%. The profitability was up by close to 37%, and the NII is up close to around 35%. Remember, the stock is a half of what it was at its peak, but that one's seeing a bit of a relief rally. Manappuram Finance, remember, that stock got slammed in Friday's trading session, particularly towards the end of trade. Now, the management has denied Reuters' report of RBI raising concerns with regard to the deal that they've done with Bain Capital. So that explains why that stock is bouncing back. Metals, they're back in focus. They had a couple of off-trading sessions last week, but Hindustan Zinc is moving up. That's the only way to play silver. And Vedanta, since it's a parent of Hindustan Zinc, and the demerger is moving in the right direction. So we see that that one as well is participating on the upside. Hindustan Copper, that's the other stock that's doing pretty well in there. That one, in fact, up and about in today's trading session. What's not doing too well? Tejas Networks continues to struggle. The stock is now down close to around 6%. Intense selling pressure is what we're seeing on that name. Remember, that's a stock which is a third of what it was at its peak, but no relief being seen on that stock itself. Net, the markets are lower. The Nifty is down close to around 60 points, but the street will be hoping at some point of time you will see some kind of an uptake because the FI short positions are at aggressive levels and the PCR is at around 0.64, which is the lower end of the band.
All right. Well, Harish Krishnan is with us, co-CIO and head of equity at Aditya Birla Sun Life Asset Management Company. Markets, of course, starting lower. Harish, good morning. Good to have you with us here. Our first chat of 2026. So let's hope the remainder of 26 is not how we've started this year off, which has been painful, Harish. And, so many money managers now talking about how they've kind of sort of reoriented and moved to large caps entirely because maybe the call is that in mid and small caps, it'll take time and perhaps there is pain for the foreseeable future. I don't know if you have a view on that specific thought process, Harish.
Happy New Year to you and to your viewers, Prashant. So we do have a similar kind of a construct wherein we do think that larger companies have a far greater risk reward. And this is borne by two particular data points. One is that we do think that, given the fact that there has been a pivot towards consumption, there is a certain amount of focus moving away from B2B franchises, which have done very well from 2020 to 2024. And we do think that there are certain set of sectors and themes which are going to be the winners of the next 2, 3, 4 years, which are markedly different from the winners of the past cycle. So there are 9 sectors which underperformed in the last 3 to 4 years, on which we think at least some of these sectors may end up being the big winners. And if you look at these 9 sectors, which includes banks, which includes IT services, which includes metals, cement, textiles, chemicals, FMCG, oil and gas and energy, etc., overwhelming amount of these sectors have a larger representation in the larger companies rather than in the small cap companies. Flip back 3-4 years back, wherein the call was more on going into the investment theme. And at that point of time, if you recall, on the PSU side, barring maybe a couple of names, almost everything was in the mid and small cap. If you look at capital goods, barring say 2 or 3 names, everything was in the mid and small cap. And so therefore, there was a greater strength going into the mid and small cap at that point of time. So that's point number one. The second point is that, there has been a lot of money chasing the small caps over the course of the last 3-4 years. And just to give you in numbers, close to about 23% of the total AUM of the Indian mutual fund industry is into small caps, which is 251 and below, which account for about 11% of total profit pools. So this is a bus which is significantly overcrowded. And while there are a lot of good, interesting names out there which can potentially surprise, we think that the overwhelming risk reward is still with the larger companies at this point of time.
So, Harish, getting back to the first point, you're saying 9 sectors had underperformed, and you outlined the 9 sectors over the last 2 or 3 years. Now, over the next 12 to 18 months, which of these 9 sectors have enough in their fundamentals to do well and outperform from here on?
So we think that there are 3 particular sectors which are dark horses at this point of time. One is the consumption pack, wherein there has been a significant amount of reset from the government side, which is focused on both tax cuts as well as monetary stimulus. This has been an area wherein companies have kind of focused on margins over volume growth over the course of the last almost 4-5 years. And what we've now been seeing in the last year or so is the focus back on volumes rather than margins. So many of the leading FMCG companies have cut down their margin guidance by focusing on volumes, and have also started using the cash flows to buy bolt-on acquisitions to further their growth agenda. So I think that is an interesting area of point. The second is IT services, wherein while we do acknowledge that there is a threat of the AI, which can kind of disrupt many of the incumbents. The reality is, I think that expectations are running very, very low. This is a space wherein a lot of companies will use a lot of these IT services to actually, do the change as far as AIification of their enterprises. And therefore, for some of them, we do think that this is a great opportunity, especially with the currency where it is in the 90s. We think that that's again a space that can be quite interesting. The third area that we think is a dark horse is the material sector, be it chemicals, building materials. Again, these are spaces where we've seen a significant amount of underperformance. In many of them, there has been a large capex or a large gross block addition, which is not contributing yet in terms of revenues. And so these are the 3 broad areas, along with metals, which has had a great 2025 and which we had kind of picked out as a dark horse at that point of time. We continue to maintain a positive stance. So these would be the areas where we do think that either there is increasing margin of safety or there is a potential catalyst over the course of the next 18 to 24 months that can drive up as far as value creation is concerned.
All right. Hi, Harish. Good to see you in. And consumption, as you mentioned, various fiscal as well as monetary measures have been put in place to boost consumption. And if I got that number correct, you mentioned in your note around $7 billion USD is the kind of push that we have seen. What do you like out there? If we could drill it down a little bit more.
So I think on the FMCG pack itself, there is reasonable amount of under ownership. This is like a pack wherein most people have a view that, valuations still are expensive. But we do think that there is opportunity out here, even though headline numbers are quite large, are quite steep. The reality is that many of them are throwing significant cash, and we think that incrementally they are headed in the right direction of focusing on volume. So here we have plays which are either into very niche personal care or into the food space, where we are a lot more positive, where the scope for quick commerce led disruption is meaningfully lesser. The other area that we are positive on is in terms of consumer durables. Again, a space where revenue pools are very, very large, but margins are extremely low. And we do think that, listing of many of these franchises will bring in certain amount of pricing discipline. This is a space, if you recall, say 5 years back, many of these B2C franchises in the durable space used to trade at 5-7 times price to sales. They've all derated to anywhere between 2 to 3 times price to sales, whereas the B2B franchises, which used to trade at, say, less than 1 time price to sales, have moved to close to about 4 to 5 times price to sales. We do think that there is a point to transition from the B2B franchises to the B2C franchises. So on the consumer basket, this is where, increasingly we are finding value.
Okay, all right. And another point, Harish, which we have discussed in the past as well, that the Nifty in gold terms is at its cheapest that we have seen all the way since the pandemic. But gold, going by the geopolitical tensions that we are seeing and, Mr. Trump, plenty of uncertainty exists in the globe. And that's why, you'll have gold that will continue to hold its own. And maybe the central bank buying as well does hold on. In that case, it'll be difficult for gold to fall from here. But you believe there's a strong case that the Nifty or equities actually outperforms gold from here on?
We do think so. Just go back to the COVID pandemic times. In March of 2020, I would imagine that the overwhelming thought process would be that we are not sure of how our own lives, our own safety would be. Forget about cash flows of companies. And that is where, peak fear psychosis kind of took over. And at that point of time, if Nifty in gold terms had kind of bottomed out, and that's the same level which is bottomed out in at the GFC level, at the dot-com level, etc. Invariably, living through these motions might always kind of give a sense that, even more worse things are going to come through. And potentially it can. See, all we are saying is from a probabilistic kind of a time frame, given that, over the course of the last 30 years, equities in gold terms have kind of bottomed out here. From a medium term perspective, it does make sense that, one should be increasingly allocated more and more to equities rather than to precious metals. Now, whether this will play out in 3 months, whether this will play out in 6 months, 18 months, 24 months is anyone's guess. It'll only be in hindsight that we'll really know. But my limited point is, when we go through all of these motions as we have during .com, during GFC, during COVID, I'm sure that there would have been peak uncertainty. And each time the nature of the uncertainty and the catalyst of that uncertainty is very, very different. And it will always appear that, these risk-free assets or the safety assets one needs to really load up on at that point of time. And I'm not saying that, gold will not perform. Don't get me wrong. All I'm saying is that incrementally one should be better off allocating to equities as an asset class from a medium-term perspective, rather than just purely chasing price action of precious metals.
All right, just take a look at the Nifty, guys. We are breaching crucial levels as we speak. The 20 DMA is gone, the 50 DMA is gone, and now the 100 DMA as well is gone. And we're at the low point of the day, 150 points. Just wondering whether the street is fearing something that's not really come to light as of now, because, we've underperformed last week. And in today's trading session, we're trading for the last 13 minutes and we're down 150 points. The Nifty Bank is trading way below the 20 DMA as well.
Look at the mid-cap index.
Is there something unknown that is plaguing the street as of now?
Nigel, I don't think so. I think it's just, there is a sense of despondency which is set in. And then you talk to a range of players that becomes very clear on air and sometimes off air as well. That's why I started by asking Harish, a lot of fund managers managing large amounts of money saying that, well, now I'm just sort of protecting NAV, protecting capital, moving to large caps. And some have sort of done it over the last 3-4 months. Some of course, some are doing it now. I don't think there's anything new in that sense the market's responding to. But it's just, there are no triggers at hand. Maybe third quarter earnings, but, again, their expectations are fairly well advertised and little by way of surprise, I think, expected. Maybe in terms of single stocks, etc., here and there, they may be. But on an overall basis, yes, there'll be some strength, etc. But I think, as I said, it's well known and people realize all of that. So without any meaningful turns around the corner, I think it's just kind of a broad sale which is underway. 0.5% lower on the Nifty is what you have. Look at BHEL. We had Renu with us in the morning, right? Renu Bedab by IIFL. BHEL is down 5.5%. It's the number one volume-led loser on the NSE. And look at Hitachi, which is Power India. It's down 5%. It's under 17,000 rupees now. And maybe we should look at the others as well, right? GE Vernova, and transformers and rectifiers, etc. I'm not sure if this action there. GE is down about 3%. CG and transformers, 4% on transformers, and CG, etc. will also come up on your screen. So, that's the picture. Just a quick word, Harish, on just that. It's just a market question more than anything else. This is not time correction. Let it correct. Let prices grow into earnings kind of a space. There is aggressive de-risking in mid and small caps, Harish.
Yeah, so I think as you laid out, catalyst in the sense of earnings growth, we do think an incrementally on the margin there is going to be an improving earnings growth, but how much is already in the price? And like I said, the bus is largely overcrowded. When we have, say, 22, 23% of total AUM in small cap with 11% profit pool share, we do know that the bus is significantly overcrowded. So it doesn't mean that, you can't create winners out of small caps, but as an aggregate, even if earnings does come through, is there a room for element of surprise? Is there room for element of further buying that can emerge from these kind of names? We kind of think otherwise, and which is where we think that there are pockets of mean reversion rather than looking at the last cycle winners. So I can say that from a small cap perspective, where we do see value and where we are buying in this fall is a lot of consumer names, a lot of consumer oriented small cap names in the material space, in the consumer durable space. They are available at 3 to 4% cash flow yield, free cash flow yield. I'm not even talking about earnings yield, etc. A lot of them are throwing 500, 600 crores of cash flow available at 13, 14,000 crores market cap with a net cash balance sheet, a lot of capex done. So there is opportunity out here. It is just that, a lot of money still is in the winners of the last cycle. And therefore, I'm not saying that, these names are going to fly through in the next 3 months, 6 months. But we do think that there is opportunity even in the small cap. It's just that the nature of the winners are going to be very, very different. And one needs to therefore view the lens and the opportunity basket from a very fresh lens rather than getting anchored to what we already own.
Harish, we leave the conversation here. Thank you very much for joining in. But we'll watch out for the dark horses that you outlined, which could potentially do well this year: consumer, IT and materials, which includes chemicals, building materials, etc. But look at the mid-cap index and the small-cap index. The mid-cap index is down 1% and the small-cap index is down over 1.5%. And this is over and above the 3.5% fall that we had in the small-cap index just last week. And the advanced decline ratio, the gap between the two will come up. One stock in the green for more than 5 stocks in the red. But now let's focus on the textile sector. The expected ruling by the Supreme Court on Trump's tariff powers did not come through. Now all eyes will be on the Supreme Court as they will deliver the verdict, hopefully, on the 14th of this month. But it's also been 4.5 months where the Indian textile industry has been facing the crushing 50% tariffs. So what's been the situation on the ground? R.K. Vij, National President at Textile Association of India, and Pallab Banerjee, MD and Group President at Pearl Global, are now joining in. Gentlemen, thank you very much for joining in. We were all hoping that the next time we speak, there would have been a resolution to the tariff issue. But as I began by saying, it's been 4.5 months. In August of 2025, Donald Trump, the president of US, imposed a 25% tariffs on India. So since then, we've been reeling with that. So Mr. Banerjee, can you give us the situation on the ground now? And then, Mr. Vij, I would like you to, throw in what you've seen in terms of have companies folded? What is the order book? How are they managing this? Mr. Banerjee, you want to go first?
Thank you. Thank you for having me on this call. Definitely 4.5 months, long time. And most of the customers do, at this point of time, don't have, they are not going to give us that support until they see that there is a light end of the tunnel. So that's what is happening for India. For order books and all, yes, all the Indian suppliers, we book the business with some kind of, tariff sharing with our customers. And that's still continuing, but it's not sustainable. And for Pearl, definitely we have options outside of India. So most of this business, we are under pressure to move more and more into those countries. And that's happening. So yes, from Pearl point of view, it is good. We have more than 70% of our business, which is outside of India. And in the India portion of the business of the order books has to be readjusted. It has to be more of outside of US, domestic, other markets. So that's what is going on at this point of time.
Mr. Banerjee, morning, Prashant here. Could you give us a sense of the industry? When you say 70% of your business, what you mean is 70% of the production for you happens outside the country.
Yes.
So in that sense, you are less affected. But India business, there is a reset which is underway and I guess ongoing. But for the industry now with these tariffs that we've been living with, what is the situation? I mean, is it for those who are largely producing in India and sending it out to the US? What's the situation?
So you see, like 25% of a penalty tariff, that's something most of the customers said no to. So they said that if you bear this portion of the cost, then we continue with the business in India. So that's, I think, most of the manufacturers of India are taking that hit of that 25% tariff, which works out to be about 15% in terms of our first cost. That means whatever my selling price is, if I go down by 15%, the landed cost after the tariff for the customer is almost the same. So that's how it has been for this last couple of quarters. And that's something I think at this point of time, most of the players, the smaller players are definitely going to give up sooner. And that means there will be job losses and factory closures in India to a certain extent if it doesn't get solved immediately.
Mr. Vij, you want to come in? Have smaller companies given up? Have factories been shut down? What is the data on the ground?
I'm just telling Ram ma'am, if you say this now, 50% tariff already is very high for India, because once we are exporting to any country, it takes us to change, and anything takes 6 to 8 months. So all the material was in pipeline, machines were set accordingly, and USA was a very big buyer for us. So this 25% higher is a very big hit for us. If you say the Tirupur market, Karur market, and NCR, Panipat market, all are suffering. And about what we have no option. So whatever the material was in pipeline, we were discounting with 15 to 20%, and somewhat the USA buyer also gave us 2, 3, 4% higher than that, but it is not for the long term. Now we have to see how to sustain further. If you see the data of September 2025 versus September data of 2024, the export from India has gone down by 6%. And from China, of course, China has gone down very much, 50%. But Bangladesh export to USA has increased by 10%. And from Vietnam also, it has increased by 2.5%. So, of course, this America is getting the material from there. And now it will be a difficult time how to go further. Of course, with the government support of FTA and other things, we are started looking after the other market, but it will take time. 7 to 8 months is very tight for us, even for the big player. MSMEs are really hit very bad, even with the big player of Gokulnath Das, Wellspan, Aryan, and these are all people are suffering because cotton was the major garment it was going to the America. About out of $12 billion in a year, about $10 billion was going to USA. So cotton is very much hit. Now, one thing is very clear that government, of course, is supporting us in terms of and the credit facilities, but this one, we should have a raw material. Cotton, government has given us 11% custom duty rebate up to till December, but it has not so far extended. So one thing we need export from the government, that man-made fiber, raw material, cotton raw material, viscose raw material should be at international prices so that we can shift over to the other country. And it is not easy to shift over other country because China, which were exporting to USA, has also dropped down, and they are also pushing to the other countries. So this is the time is there, but it will take 8 to 9 months to adjust these things. Of course, PLI scheme is there. Our Indian domestic market is very good, but it will take. It is a very tough time, next 6 to 8 months, and so that we can find out other markets.
Okay, all right. Got that, sir. Pallab, coming back to you, as you were mentioning that you're trying to de-risk yourself, and that's why a lot of production can happen outside India as well at the other facilities. we'll just pull up a chart. The facilities that you have all across the globe should come out, and Bangladesh is particularly a large part of it. You're de-risking yourself with regard to exports to the United States. But what about the tensions on the border? India-Bangladesh tensions, well, they have perked up a little bit in the last few weeks. Is that a bit of a risk to your business?
Not really, because you see, Bangladesh is very much dependent on this garment manufacturing and exports. So what we are seeing, Nigel, is that definitely the industry is doing fine. There is definitely a political turmoil at this point of time. And there are some benefits also, like, India, the domestic market is buying less and less from Bangladesh. So that might be giving some kind of opportunity for the Indian manufacturers to do more of domestic business. But yes, in general, we are not seeing any change. Also, if you look at it, the Western markets, they are doing pretty well at this point of time economically. We thought that there would be, due to tariff, there would be some kind of slowdown or lack of demand, but we have not seen that. Whether it's US market, the European market, or like even Japan and Australia, I think the markets are doing well at this point of time. So yes, it's a little bit frustrating for being in India at this point of time due to this tariff. We are not able to capture this opportunity. But if I look at as just now Mr. Vij also mentioned, the Bangladesh, Vietnam, and other countries, they're experiencing a good growth at this point of time.
Mr. Banerjee, in August, what was the company's exports to the US? And now what does it stand at? Trying to assess if you have managed to diversify your output to other nations, because that process also takes time. So it's underway, the efforts are underway. But to what extent have you managed to do it? So if you could share some numbers to illustrate that.
So yeah, for example, if you look at Pearl Global, we have almost 70% of our manufacturing was happening from Bangladesh, Vietnam, Indonesia, and Guatemala. And India was constituting about 30%. And in that 30%, we had almost about 50% was a US market and the 50% was the rest of the market. So the trend that we are seeing now is that US market is going slower. That means it's diminishing for India manufacturing. And that part of the business, if I look at US specifically, I'm experiencing a significant growth both in Bangladesh and Vietnam and Indonesia. Of course, Guatemala is favorable for US always. So these are the places where we're seeing a significant growth that's happening, not only for US, but if you see that the Western markets like UK, Europe also have done some kind of FTAs, which are already active in Vietnam now. Bangladesh always had it. So that way, like we are seeing growth in these markets in terms of my order books, a significant growth. If I talk about India, yes, that 50% of the US component is slowing down a bit. I have to quickly replace it by other markets. So that's the transition that we are going through. So maybe like this particular year, I might drop down the India share a little bit just to compensate this, because other important part is US was the most, I would say, attractive market. The order sizes were good, customers were reasonably good, and good pays. I would say the price points were better. As just now, Mr. Vijay also mentioned that there are a lot of dumping happening from China to other markets, whereas US and the Western markets were more clear of, to reduce or de-risk from China. So that's helping in terms of the other markets, whereas for India, we have to compete in all these other markets. United Kingdom, we had a FTA which has been signed, but it's not yet actionable as of yet. European Union, we are expecting, but yes, a lot of geopolitics at this point of time, and we don't know which way it will go.
Okay, all right, gentlemen. We look to reconnect with you all and get an update. Hopefully, things flow in our favor. In fact, companies do battle past this a bit of a difficult phase and then conquer in the time to come. Thanks a lot for joining in and giving us your perspective. Well, the markets did see a bit of a bounce from the lows of the day, but that got quickly sold into, and we're back down close to around 130 points or thereabouts. Extremely crucial zone. This 25,500, 25,550, extremely crucial zone. You don't want this level to break on a closing basis. For the time being, we slip into a short break. On the other side, Manisha Gupta is waiting for us. She'll turn the spotlight on the commodity space. Welcome back. Markets are still down 130 points, but some of the larger constituents are trying to fight for the bulls. I think HUL is a stock that's now moved to the high point of the day. It can do little, actually, when you have this sort of selling, but that one as well is holding one end up. Interglobe Aviation actually has cut its losses, so that one comes up for you on the screen. I'm not sure whether or not the street is believing that the FMCG index could be the pocket to hide, because that index is trading a little bit in the green. But let's get you, some commentary that we got over the weekend, actually. SEBI chairman, Mr. Pandey, indicated that the process of granting an NOC for NSE's IPO is nearing completion. Let's listen in to what he had to say.
I think we are at very advanced stage of issuing the NOC for NSE IPO. When can we expect? Maybe within this month.
All right, eagerly watched NSE IPO could be getting a bit of a leg forward. But let's also listen in to what the NSE MD and CEO, Mr. Ashish Kumar Chauhan, had to say on the potential IPO.
Today we had a great darshan in the early morning at Tirupati Tirumala Devasthanam. We took blessings for NSE and for all our members or our shareholders and the country. Yesterday only the Honorable SEBI Chairman announced that this month NSE will get an approval for IPO, and we had planned this Tirth Yatra long back, but it happened that yesterday only when we arrived in Tirupati, the announcement was made. So we think it is a good omen and God's blessing that this announcement has come from SEBI.
Well, the SEBI chairman also commented on the further course of regulatory action in the derivatives market. Let's listen in to comments on that front.
In the derivatives, we have taken a number of measures, as you know, earlier, first in October 24, and then in May 25, and the last of the measures got kicked in December 25. So we are looking at the data, and after the data is there, we will be able to define our next course of action. So at this moment, I don't think that we are going to disturb anything.
Okay, all right. At least we've cut our losses by close to around 50 points from the low point of the day. Coal India has moved up a little bit. I don't know, maybe, actually the Nifty Bank, that was down 280 points. That's cut its losses, and that definitely helps because it's the largest constituent of the index. It's gradually moving towards the 20 DMA. Boy, oh boy, I'll tell you what, the bulls will want it to get closer to around that mark on a closing basis. For the time being, some bit of a relief rally. To be fair, actually, the Nifty has cut its losses by half from 160 points down. Now we're down only around 80 points, but we need to sustain these sort of levels and then hope. First, the Nifty needs to stop falling. And then since you have a market that's net short, the odds of seeing a short covering bounce actually move up. So that's the important trigger on the index. Let's address a couple of pockets of stocks, though, that are reacting. Vinny joins us to tell us about the capital goods stocks. Vinny?
Hi, Nigel. Good morning. So these capital goods stocks, if you see, since the second half of last week, we've seen them see a fall coming. And why? First, there was a report that came in that Reuters said that there's a high-level government committee that came in. They're recommending that, Chinese firms now could start bidding for these government contracts, especially coming in for power, railway and other sensitive contracts. Now, these restrictions were placed on these contracts when? In 2020. Now, obviously, there's an impact that comes in for all these companies if these restrictions are lifted. So we started seeing a sharp correction coming in. When you look at L&T, BHEL, which are mainly into boiler turbine generator suppliers. So BHEL, these were the contracts which they spoke about that maybe the restriction could be lifted on this one. Hitachi Energy, GE Vernova T&D, Siemens Energy, CG Power, they are in the power sector equipment play, as well as other stocks like transformer rectifiers, ABB, Siemens. All of them also fell in trade or are falling even today. Why? Because they're a part of this manufacturing supply chain. Then there was a clarification that came in, also reports that was suggesting that, maybe this is not going to be happening. And as of now, as per CNBC-TV18, the sources also suggested that no decision as such has been taken on this front. So that was an important update. But despite all of this coming in, there was no respite for any of these stocks. Today also a sharp fall continues for them. Now, what are brokerages suggesting? Whether you look at something like an IIFL, we spoke to Renubet today as well. report has suggested that Chinese company TBEA is likely to participate in this power grid tenders, and only restriction maybe is likely lifted for only these high voltage transformers or reactors. On those fronts only this restriction is lifted. This is according to the channel check that she suggested, but not as a whole for the sector as a whole, that Chinese company can participate across the capital goods or industrial sector. It's not across that. That is what brokerages are highlighting. Even IIFL said that as well. Now, Jeffries also is saying that if this actually happens, highest impact coming for BHGL, L&T, Afcons, ABB, CG Power, low impact for defense companies, and T&D companies would see a lesser impact coming in as well. Bernstein also said that industry checks are suggesting that relaxation is only in some of these sectors, not all of the sectors, or some particular products. So important update is that if it comes in, it could be only for some particular products. As of now, there is no decision that's coming on this front, but pressure continues on the sector.
Thank you very much for that. It's over to Sudarshan now for more on Meesho and Grow.
So two initiation, BofA Securities has initiated coverage on Meesho with neutral call and targets given is of 190 per share. It says company is well placed to target value-focused mass market segment, and it believes in FY 26 to 29, NMV CAGR can be as high as 26%. And adjusted EBITDA margin from FY 26 that company had reported of -3%, it can increase to more than 3% by FY 29. So from -3% FY 26 to +3% by FY 29. And at current levels, valuations are factoring in strong fundamentals, and tailwinds are room to gain market share, fintech scale-up, and grocery expansion if company plans to undertake. Second one is Kotak Institutional Equities has initiated coverage on Grow with a buy call and targets given of 190 per share. And its constructive medium-term views factors in few positive catalysts. First, durable product-led growth flywheels. Second, expanding monetization across broking, margin lending, wealth, and consumer credit. And last one is scalable in-house technology. So positive brokerage notes for Meesho and Grow.
Okay, all right. Thanks a lot for that, Sud. Well, let's also focus on a couple of these other names. Premier as well as Wari, they are in focus post the news flow coming in for China over the weekend. Vivek joins us to decode that for us. Vivek?
Well, that's right. So on January 9th, the Chinese Finance Ministry went ahead and cut export rebates, cut the kind of support that they were giving to a whole host of value chain additive companies across quite a lot of sectors, key amongst them being the solar renewable energy sector. Now, what actually has China done? China has gone ahead and cancelled value-added tax export rebates for photovoltaic products, and this will be effective from April 1, 2026. Now, remember, China had previously reduced the export tax rebate for photovoltaic products to 9% from 13% in December 2024. So now, overall, how do we look at this particular impact as far as the India value chain is concerned? A whole host of PV modules, cell companies will marginally benefit. So names like Premier, Wari, even Vikram Solar, MV Photovoltaic, all of these names marginally benefit, and even a name like a Borosil Renewable, given the fact that solar glass too comes at much cheaper rates from China. But one important thing to note is that the Indian domestic market already has quite a bit of support. There is a 40% ADD on solar modules, a 25% ADD as far as solar cells are concerned, and along with that, there is also support in the form of ALMM, which is the approved list of module manufacturers, and also an approved list of cell manufacturers. Only those companies incrementally will be able to supply to renewable energy products. It's a mild negative for RE developers, but a marginal positive for PV module makers as well as cell suppliers.
Thank you very much for that. Almost 10 o'clock. Let's just get in Vinay Rajani of HDFC Securities now for a quick technical check on the market. Vinay, tough morning, tough start to the week, but markets trying to bounce back a tad bit. What is your read of the first 1 hour of trade? And would you have a strategy on the Nifty, Nifty Bank, and any of the big stocks?
Yeah, good morning. So tough day, definitely, and it has been 6th consecutive day of fall, and Nifty has already witnessed a 850 points fall from the recent swing high of 26,373. So it has been quite weak setup, and we have been underperforming the global markets. Despite positive cues from the Asian markets, we are not able to recover. So that is a bad sign. Positionally, we are now below 50, 20 and 100 days exponential moving average. That is also another weak sign. But yes, since we have fallen a lot in last 6 sessions, we cannot rule out the possibility of the pullback in the market. So yes, there was the previous support at 25,700. Up to that level, we can see some recovery from this level. So risk reward ratio is not favorable going short over here because it looks oversold on the short term charts. So I'm expecting some pullback rally to come in the Nifty in the range of 25,700 to 25,750. There could be a bounce up to that level. So better to wait for that level to come and then you can think of going short again. But as of now, it looks quite oversold. Wait for a pullback and pullback should be around 25,700 to 750. And Bank Nifty also closed on a weak note. So in that also, it would be better to wait for a pullback and then we can execute the short strategy. So oversold right now, but positionally definitely it is weak. So lighten your commitment at higher levels.
Okay, all right, got that. Oversold, a bit of a recovery, but you could lighten yourself if in case you do get a bit of a bounce. Vinay, what about individual stocks? Give us some ideas.
Yeah, so looking at the global commodities, industrial metal strength, I still feel that the stock like Hindustan Copper can do well. So it has been very strong in recent past and still looks like that it is headed higher. So Hindustan Copper can be traded long around 528. I would suggest a stop loss at 515. On the upside, I'm expecting a target of 515 in couple of sessions. The another strategy would be to sell in the some of the capital goods stocks like Cummins India around 4050 4070. One can look for shorting in the January future. I would suggest a stop loss at 4130, and on the downside I'm expecting a target of 3980. So Cummins India on the short side, which is January future, and Hindustan Copper on the long side with a stop loss of 515.
Thank you very much for that. And now let's turn our attention back to the commodity markets. Manisha is now joining in. Manisha, what are you looking at?
Well, all-time highs that the precious metals seem to be trading at is something that we'll need to talk about because gold is now trading at $4,600 an ounce. We have seen prices gain up by 4% in the previous week. And when you look at 2025, as we've been discussing, it had gained 64%. So the rally really started in the 2023 in the month of September. But from the 1st of January to where we're trading right now, gold prices have given you 140% returns. If you look at overall demand, apart from the geopolitics and macros as well, the estimates are that for 2026, the demand for gold globally could hit 4850 tons. Now, this is the highest since 2011. So we seem to be making records in various directions there. Take a look at the silver prices. 4% of gains is what we started Asian markets with. Last 1 year has seen 182% of gains come in for the silver prices. And this year, so far, we already have done 17% of gains there. Support clearly coming in from the weaker than expected U.S. payrolls data. Markets were anticipating a 66,000 of a number. What we got on screen was 50,000. That has led to a decline in the U.S. dollar index, supportive for precious metal prices. The street also estimates that with the kind of jobs numbers that we are looking at, you could be looking at least 2 rate cuts in the year 2026, and that in turn also has been supportive for the prices there. Also, it has been about safe haven buying. The US-Venezuela tensions has been supportive for gold prices in sense of tangible buying there. And then there is also unrest in Iran intensifying. That has been supportive for global gold demand. The dollar index declining as a criminal investigation on the Fed chief, Jerome Powell, puts Fed independence into question, has been one of the reasons that we've seen a lot of safe haven come in for the tangible commodities. So when you look at what the markets will watch out now for, is in focus is the U.S. inflation data, and the key bank earnings this week is what the markets will take cues from. In the meanwhile, you also have, over the last 2 or 3 days, seen more reports coming from the international banks. UBS for now has changed its estimate for the gold prices, and this year they believe that $5,000 an ounce is a possibility by the month of March. HSBC, in the meanwhile, also says that the first half of 2026 could see $5,000 an ounce for the gold prices. Last plate should come in on your screens, which shows you on what we've done in sense of commodities for 2026 till time. So gold price is already up 6%. Silver outperforming yet another year until time, at least 17% of gains coming in for this one. Copper, we've seen all-time highs in the previous week, and we've seen 5% of gains already for this year. Crude prices, 3 years of decline. This year has started positive, 4% higher. Aluminum is gained 5%, and platinum continues to be in that race as well, 15% up already in 2026 for that one too.
Okay, all right. Thanks a lot for that, Manisha. For the time being, we'll slip into a short break. On the other side, an exclusive conversation with the Asia head of private equity, Warburg Pincus. on their 960 crore rupee investment on Lemon Tree Hotels and more. Stay tuned.
Hello and welcome to this edition of the Newsmaker. Over the weekend, a big deal in the hospitality space. Lemon Tree Hotels has announced a strategic reorganization of its business, creating two distinct platforms: an asset-light hotel management company and a scale hotel ownership and development vehicle, Fleur Hotels. As part of that transaction, Warburg Pincus, the private equity giant, is acquiring APG's entire 41% stake in Fleur Hotels and committing up to 960 crores of fresh primary capital to support its next phase of expansion. It is also a renewed partnership. Warburg Pincus was an early backer of Lemon Tree nearly 2 decades ago, helping build what is today one of India's most recognizable mid-market hospitality brands. The latest investment comes at a time when India's travel, tourism and discretionary consumption cycle is seeing a structural upswing supported by infrastructure build-out and rising domestic demand. With such a landmark move to kick off 2026, we thought it would be the perfect opportunity to speak with one of the primary architects of this strategy. We are joined today by Vishal Mahadevia, Managing Director and Head of Asia Private Equity for Warburg Pincus. Vishal also serves as the Global Co-Head of Financial Services, a role that is particularly relevant given the firm's recent successful $3 billion close of its third financial services fund just a few days ago. Well, this interview also comes at a momentous time for Warburg Pincus as the firm celebrates its 60th anniversary this year. Since its founding in 1966, the firm has become a pioneer in global growth investing, now managing over $100 billion in assets across more than 215 portfolio companies. In India, Warburg's journey began in 1996, making them one of the earliest and most successful global PE firms in the country, with roughly $10 billion invested in India to date. Their portfolio reads like a who's who of industry leaders, from the early success of Bharti Airtel to current powerhouses like IDFC First Bank, CAMS, Kalyan Jewellers, and many more. Air India has, of course, been one of the large new bets as far as the consumption space is concerned. Vishal, of course, has been at the center of that journey, helping deploy capital through multiple cycles, build scale platforms, and deliver some of the market's most closely watched exits. Vishal, it's a pleasure to have you with us here. Thank you very much. Thanks. Congratulations on the big deal with Lemon Tree. And of course, I mean, at the outset, let me say congratulations. 30 years of Warburg in India, 60 years of Warburg, as a firm.
Thank you, Prashant, and it's great to be here. Thanks for having me. It's actually quite amazing. 30 years, 3 decades in India. When we first came out here, I think the economy was less than $500 billion GDP. It was really not on anyone's radar. And being here for 30 years, through ups and downs, through all these cycles, we're just terrific. So happy to be here. And we're lucky that we've been able to partner with some of the best entrepreneurs. And you started out talking about Lemon Tree, but to be back with Patu, as when we just started more than a decade ago, working with him, it's just been terrific and great to be back with him.
We'll come back to a little later in terms of the journey of Warburg itself and what's ahead. But Lemon Tree, you're coming back in a way, right? Because you were there in the beginning 2 decades ago. Small company, it's a very large sort of company now. What's the logic? And just tell us a little bit what investors should expect now after this transaction goes through.
Sure. Look, I'll give you 2 very simple reasons we're back with Lemon Tree. And number one is Patu. I think in India, in 30 years, we've seen who you do business with, who you partner with, is much, much more important than the company that you invest in. And so a chance to come back with Patu and his entire team and seeing how they've grown and built really one of the leading hospitality businesses in India is terrific. 2, I really think hospitality is at an upswing. You've got all the reforms, the infrastructure build that's happening in the country. You've got a more affluent consumer in the country that's aspiring, that wants more. And as you have this increase in domestic travel, not just tourism, but even business, even overall larger and larger companies, I think Lemon Tree is in a great position to benefit from that. And really, with our capital and hopefully with our partnership, grow that business.
You're also buying out APG's 41% stake in Fleur, right?
Yes.
What was the logic there? And they had to get out. They wanted to sell, and what? Just talk to us a little bit about that.
I won't comment on APG, but I would only say they've, as they've said publicly, they've done very well. They've been great partners for Patu. But like all financial investors, there comes a time when you've generated very good returns for your partner, and the partner needs an exit. And we were lucky enough with Patu to be able to buy out the stake, come back in, and be a partner with him, and not just buy out their stake, but really provide this additional capital to help grow Lemon Tree, which is the fuel again for the hotel business.
So actually, the overall transaction is much larger in that sense.
Yes,
right?
it is.
There's that 41% for what you're paying.
That's exactly right.
A meaningful sum, and then there is this primary capital of 960 odd crores as well.
That's right. The overall transaction size is multiples of the 960 crores. And hopefully there's even more of that in the future, because we are very positive on both Lemon Tree and the hospitality business in India.
And this, the logic behind asset light and asset heavy is two distinct entities now, right? In that sense.
I think there will be two distinct entities because two have very different capital needs. And really someone with our capital and the scale of our capital should be in the asset heavy entity to help them continue to grow where capital is required and us to come in. And there is a asset light business at Lemon Tree that will continue. And both will really continue to thrive side by side as they become public companies.
Typically, this kind of a bet now is going to run for how many years? This is you're in it with no finish line in that sense?
Yeah, no finish line, only because it's so hard to find good people and good companies to invest in. And when you find it, as in private equity at least, you then want to be in there.
And then come back.
Continue there.
Come back.
Yeah, exactly. Why not? Why not?
The investment in Air India, right, with Bharti Enterprises.
Yes.
And of course, you work with Bharti. It's been one of the oldest associations here in India in that sense. Again, it's a consumer bet. So talk to us a little bit about that. What do you aim to achieve with that one?
Yeah, look, Haya India, amazing company. They've grown 25% compounded annually over the last however many years, grown to become the #3 brand in India in white goods. We've known Haya very well for years. We've known Sunil, of course, go back to early days in India since 1999. When we made our first investment in Airtel, when it was just a North Delhi cell phone company. And we've come back again with Sunil in the past. So it really is, you see a little bit of a theme. Who we do business with is important. And a chance to partner again with Sunil, to partner with Haya in this new structure, and then create another Indian champion. Make in India, make for India, alongside Sunil, who understands the Indian consumer as well. I really think it's a terrific cocktail. A lot of hard work, a lot of execution required, but the opportunity is tremendous. Again, affluent Indian consumer. They want to buy better goods. They want value for money for their purchase. They trust brands. They want better technology. So all in all, if you can pull all of that together, I think Haya in India can have tremendous success.
You know, the big story for the last 15, 20 years with regards to the consumer in India is that, we all used to look at what's happened in China and say, well, look category by category. What's happened here, there will happen here. Per capita consumption of this and that, etc. Everything from ACs to footwear to everything. You have extensive amounts of experience in China. You travel extensively across Asia, for that matter. Is that thesis still correct? That is the broad way to look at it, or is there a change?
No, I think I would say India will develop very differently in terms of both the speed and the level of its penetration rate and what consumer categories India will have. But the direction of travel is undisputed. In fact, what really changed, I think, for India and accelerated that trend from unbranded to branded, from unorganized to organized, was COVID. That actually changed everything. People were more comfortable using technology, buying online, paying online, digital payments, everything enabling that system, along with the government regulation that happened, a decade ago. It just accelerated this trend. And so you have the Hayas of the world. We invested in a company called EBCO, in a company called WaterTech. As you go down that list, I think that trend has accelerated. It was always there, but Haya sits in the forefront of it.
So from a consumer perspective, the broad bet is premiumization across categories.
I think
that is what you're betting on.
I think the broad bet is premiumization at every level. So someone at the bottom of the pyramid is premiumizing what they used to buy, and someone in the middle of the pyramid is premiumizing what they need to buy. So it's not just premium products. I actually think you want to be able to serve that mass market in India, but every Indian consumer is aspiring to buy a slightly more premium product, and you have to be able to cater to that with good value and better products.
You know, what we're going to do, Vishal, is take a quick commercial break here. We'll talk about financial services. So many transactions lately. You've closed a very big fund, and I'll ask you where you plan to invest and put some of that money, especially in the Indian context. So stay with us. We are back with Vishal Mahadev of Warburg Pincus in just a bit.